Hello everybody, my name is Jeremy Zirin and I'm the Senior Real Assets Analyst at Marquette Associates, and today I'm here to talk to you about real estate. But instead of covering the traditional fundamental factors such as cap rates and NOI growth, I'm here today to talk about demographics, and specifically the millennial generation and their impact on real estate investments. But before jumping into the demographic talk, let's start with a quick overview of commercial real estate. When we talk about commercial real estate with our clients, we think about it in the context of both the NCREIF Odyssey and the NCREIF Property Index, or NPI for short. The NPI is a composite of real estate investment performance from a very large pool of individual commercial real estate properties acquired in the private market for investment purposes only. The NPI invests in real estate across various property sectors, as you can see from the pie chart, and the majority of which is invested across apartments, industrial, retail, and office. Since these four represent the majority of the NPI, this is what I'm going to focus my attention on throughout the remainder of the presentation. And as I mentioned earlier, rather than talk about the traditional fundamental factors driving real estate returns, one of the major themes driving investment opportunities within real estate has been the demographic trends in the millennial generation. So who are these millennials and why do they matter? Millennials. Some of you in the room might know a millennial. You might be related to a millennial, you might be sitting next to a millennial, or even be a millennial. In fact, you might even be looking at one right now. There are nearly 80 million Americans considered millennials, born sometime between the early 1980s and late 1990s, and today they're turning around 20 to 36 years old. Millennials aren't just the next generation after Generation X and the baby boomers. Instead, millennials are a pretty impressive group of people. Let me explain what I mean. Millennials are culturally diverse and gender balanced, technology and people savvy, more likely to use public transportation, prefer urban life and pedestrian culture, a work-life balance is paramount, green is good, and they are mobile and more willing to relocate. So let's take it a few steps further by exploring their housing, income, employment, self-image, and student debt in the following slides. Starting with housing. More than 3/4 of millennials live on their own, including the 26% who own and 50% who rent, and over 1/5 live at home with their parents, just like Will Ferrell and John Raleigh did in the movie Step Brothers. While the percentage of millennials that own is relatively low right now, I would expect that to change, because even though most millennials currently rent or live at home, most of them actually express interest that they want to own and be homeowners, but the situation just isn't right now. Moving on to income. Incomes vary widely among millennials. 14% of millennials who work full-time make less than $25,000 a year, and only 20% earn more than $75,000. Lower employment levels and smaller incomes have left younger millennials with less money than previous generations. With respect to employment status among millennials, 62% work full-time, 15% work part-time, and 9% are in school, interning, or volunteering. Since millennials represent the largest generation in the workforce and are expected to represent roughly 75% by 2030, there are a couple things I think you should know about us. First off, the average millennial tenure at a job is about 2 years compared to 5 years for Generation X and 7 years for the baby boomers. So if you aren't willing to let them grow, they're going to seek growth somewhere else. Secondly, despite what you baby boomers in the audience may think, we are not lazy. It's called being efficient. Millennials have no problem working long hours on projects that require additional time and attention, but they just don't like sitting around waiting for the day to end when they know the work was done 2 hours ago. With respect to self-image, interestingly, only 37% identify themselves as city people, but almost half live within central city boundaries. As the chart on the right-hand side illustrates, most millennials live in city neighborhoods outside the actual downtown area, where only 13% of millennials live. When you look at where millennials actually live, the downtowners are clearly atypical. Instead, many millennials live in central cities, but not necessarily downtown. Millennials value walkability, mixed-use neighborhoods, and gravitate towards denser settings rather than outlying suburbs. And finally, student debt, because no conversation about millennials can go without talking about it. Student debt has been widely characterized by the media as one of the most significant deterrents to home ownership among millennials. Although very significant for some, what the media has reported looks to be a little bit overstated. Now, nearly half of millennials have no student debt at all. 38% never had it, and 10% already repaid it. Of those with outstanding balances, shown on the pie chart on the right, nearly half are carrying less than $25,000. So now that everyone is an expert on the millennial generation, let's dive right in and take a look at how millennials are impacting the four main real estate sectors: apartments, industrial, retail, and office, from a demographics perspective. Starting with the multifamily and apartment sector. So home ownership is currently at historical lows, around 64%. From a demographics perspective, millennials are delaying significant milestones such as marriage, having children, and of course buying a home. All of which, however, has been very favorable to the renting and overall multifamily and apartment sector. New renters and new owners on the graph represent the change in renters and owners from the previous year. Over the past several years, there has been a significant increase in new renters relative to new owners. As millennials enter their peak home buying years, the reluctance to enter the housing market could change. The cohort's sheer size plus its desire to settle down in the future could lead to a surge in home prices. For the near term, however, there are a significant amount of millennials still in school or about to enter the workforce, and as a result, demand for apartments and multifamily remains strong. Adding to the previous slide where I showed home ownership rate as an overall percentage, you could see from this graph that the percentage change in home ownership among millennials and people between the ages of 35 and 44 has been on a significant decline relative to all age groups combined, and since peaking before the financial crisis. So why does this matter? Well, the millennial generation is the biggest in US history, even bigger than the baby boomers. And by the year 2050, millennials and the generation after are going to represent the majority of the US population. When you think about it, because millennial generation is the largest in US history, as they reach their prime working and spending years, their impact on the economy is going to be, as our presidential candidate Donald Trump would say, huge. Huge. Moving on to industrial. A major theme within industrial sector has been the story of e-commerce as it continues to gain market share from the core retail sales as shown on the graph. When millennials order online, they expect to have it shipped to them within 24 to 48 hours. Because of this and the increase in e-commerce sales overall, companies are looking to buy or lease industrial buildings closer to higher density populated areas rather than the middle of nowhere. This slide shows a picture of one of Amazon's fulfillment centers. Amazon is a great example of the industrial sector as it relates to the increased demand in e-commerce and the changing demographics of millennials. From drones to moving closer to higher density populated areas, Amazon has increased its square footage on fulfillment centers, data centers, and other industrial space from 44,000 square feet in 2005 to over 120,000 square feet in 2015. An example of this trend was this past June when Amazon announced plans to open two fulfillment centers, two in Edwardsville, Illinois, and an additional fulfillment center in Joliet, as you can see on the map on the right, both of which offer premier locations and transportation networks for the company. So while e-commerce is driving performance within the industrial sector and likely a major attributor going forward, overbuilding and monitoring supply levels in certain areas will be something to keep an eye on. Moving on to retail. Brick and mortar sales are being constrained by internet retail and the shifting age demographics. Brick and mortar as a percentage of expenditures has gone down, while services has gone up. A recent example of this trend is an announcement made by Macy's this past June in August to close 100 of its stores by early 2017, which represents about 15% of all of its department stores. So what types of services are millennials spending their money on? Well, millennials want to spend money on something that will give them a good experience. So experiential services such as restaurants and bars, those are areas that have shown significant strength. Also, e-commerce resistance formats, mainly perishable goods and essential services such as grocery, personal care, and the fitness centers such as, maybe you've heard of it, Core Power Yoga or Orange Theory Fitness. These have been very popular and have a lot of high leasing trends in the sector. Going forward, an improvement in the labor market, broadening wage growth, lower gas prices, and rising consumer confidence should lead to continued strength in the retail sector, specifically around e-commerce formats and select brick-and-mortar stores. And lastly, we have the office sector. Office can best be characterized with the trend known as suburban migration. Companies are relocating from the suburbs to central business districts in order to be closer to the talent. In Chicago, the West Loop has benefited the most from suburban migration, accounting for 65% and over 3 million square feet of migration leases. The proximity to train stations and the interstate make it a premier location for companies relocating to the CBD that still have a sizable share of suburban employees commuting to work. Two recent examples of new leases from the move to the West Loop are the Google building on the left, which recently moved its headquarters from River North to the Fulton Market area, and the rendering of McDonald's on the right, which just contracted on the old Harpo Studios where the Oprah Winfrey Show was produced. In the near term, delayed supply in select markets should allow for continued occupancy and rent gains. However, oversupply is already at risk in some key office locations. Being selective and focusing on highly walkable locations with convenient transit access will be critical. Proceed with caution here. So what does this all mean for us in the future of real estate investing? First and foremost, it is important to remember that the millennial generation is the most dominant generation in American history and the most dominant demographic for the next 50 years. I think we can all now agree that we're a pretty impressive set of people. In regards to the four main real estate sectors, though, home ownership rate is at all-time lows, partially due to millennials starting a family later and renting for longer. As a result, demand for apartments and multifamily remains strong, especially as younger millennials enter the workforce. With regards, within the industrial sector, companies are seeking industrial buildings closer to high population density areas, seeking premier locations and transportation networks to meet the demand and of faster leasing and the growth within e-commerce. Within retail, consumer spending has shifted away from the traditional brick and mortar, benefiting service-oriented retail. And within the office sector, companies are migrating their office buildings away from the suburbs and into the cities, and leading to new development opportunities in select markets. So while we are seeing shifting trends occur within each of the four main real estate sectors, a diversified investment approach across all four may provide investors with the best risk-adjusted returns. Millennials are changing the way businesses think and how real estate investors invest in the future. Thank you.